Joining me now is Fundstrat co-founder, managing partner, Tom Lee. Tom, good to have you back. Now, I know you're saying that the bottom is in for the market from that early August move. I'm still fixated on your expectations for small caps. I've been talking about them a bit in this hour through the rest of the year. You still think that they could go up 40% by year end?
Yes. John, for small caps to rise 40% means that the PE, the median Russell 2000 stock, goes from 10 times to 14 times. So it's not asking the market to provide some magic and a huge revaluation. It's actually just saying small cap stocks, which have been left for dead largely because the Fed's been tight for almost 2 years, as they start to normalize policy and as mergers pick up, its merger activity has been accelerating this year, and it should really strengthen because it's a sign of CEO confidence. All of these flow through to benefit small cap stocks, and it's not like smaller companies are growing slower. I know people post all these stats about small caps losing money. It's mainly because of the biotech components basically don't make money, and that's the largest cohort of stocks in the Russell. But the Russell 2000 median earnings growth is almost 700 basis points faster than the S&P, and top-line growth is almost 400 basis points. So you're getting better growth, lower valuation, and I think the catalyst is now when the market is convinced the Fed is embarking on a rate-cutting cycle.
Okay.
Could happen Friday.
Okay, so if a 40% upward move happens for, say, the Russell 2000, what happens for mega caps? What happens for the broader S&P 500? Do you expect them to have similarly dramatic moves, or is there a major rotation that you're expecting?
Well, John, we've already witnessed this happen in large caps. Nvidia's risen 40% in 8 trading days. So when someone says the Russell 2000, which is made of even cheaper companies, can't rise 40% in the next 5 months, they're forgetting that we've already seen huge moves in the mega caps. I don't think the mega caps have to go down.
Do you expect it to happen in isolation with the small caps is what I'm getting? I know that Nvidia's done that. Some other stocks have done that themselves. But if you're talking about all of the small, the small caps as an index moving up that much, what do these other things do?
Well, I think that a 40% move in small caps doesn't mean the rest of the market goes down. I just think that's going to highlight that the market is broadening, which is something we all expect, but it's also basically doing a risk-reward analysis, which is, look, I think if you can get 18% earnings growth and pay 10 times earnings, perhaps that's a good risk-reward. And I think money that's on the sidelines, or people who've been thinking bonds are going to be, and cash is a place you want to stick for the next 5 years, but if the Fed starts cutting, they're going to look for places where there's good risk-reward, and I think that's small caps.
Do you need dramatic cuts for that thesis to pan out? Or are there other potholes in the road that you see that threaten your thesis?
Well, a recession would be negative. I don't think the Fed has to make major cuts. It actually just has to. I think the market narrative that would be the best for small caps is the belief that real interest rates are too tight now, 5.5% versus inflation trending towards 2%. And getting rates back down to a neutral rate of 3%, if the market believes that, they don't need the cuts to be front-end loaded, but they have to believe we're going back towards neutral. I think that'd be a huge catalyst for small caps.
Okay, now let me ask you about more about mega caps and about the consumer. How important, not necessarily just to small caps, but to the whole market narrative, will Nvidia earnings next week be?
Well, Nvidia is really important because it's underpinning really what is driving the U.S. economy, which is a real push towards productivity, using basically digital tools and automation. That's a very important disinflationary trend. And of course, the U.S. companies, all of the big ones, are all the U.S. I mean, it's a global phenomenon that benefits U.S. companies. So I think it's incredibly important. But Nvidia, trading at 26 times forward earnings isn't that demanding a stock either. So it's not like I would say sell Nvidia to buy small caps. I think Nvidia is still a long-term buy.
Alright guys, this is the part of the video where I'm going to break down the stocks that were mentioned in the CNBC clip. Today they mainly talked about the Russell 2000 small caps, but we're also going to look at the S&P 500 and the NASDAQ. So we'll briefly break down those three ETFs. If this is your first video, the blue line is the 45-day moving average and the green line is the 200-day moving average. So you can see the Russell 2000 has been chopping sideways almost this entire year. We broke above the 45-day moving average, consolidated like we were going to go higher, and then faked out all the way back down to the 200-day moving average. Since then, we've made a nice double bottom on this 2000 price range, and now we're headed back to the upside where we've broken above the 45-day moving average. So that's bullish on its own. When you also take into consideration we had a bullish cross of the 45-day moving average and the 200-day moving average back here, we've also been putting in higher lows every single time we dip. Those are all bullish signs and show that we continue to remain bullish. Even though we're not making the same gains that we are in the S&P 500 and the NASDAQ, Tom's thinking that we're going to catch back up and gain another 40% by the end of this year. So that would just be outstanding. What you would need to see is them to hold this 45-day moving average, chop around, make it a nice support, and then continue back to the upside. For the bearish case, this could just be a shakeout above the 45-day moving average. If we keep selling off from here and come all the way back down to the 2000 price range, that's going to be extremely bearish. You could also argue that'd be a head and shoulders pattern. This would be the first shoulder, this would be the head, and then if it comes back down, this would be the second shoulder, which is extremely bearish. But as of right now, we're holding above the 45-day moving average and we are looking bullish. We still have a few major gaps in the chart that we need to get to and close above to remain bullish. Most price action gaps on the charts do get closed, especially in the ETFs, so I wouldn't be surprised to see a little bit more of a move, even if we're going to fake out and come back down, just to close this gap. Onto the S&P 500, guys. We've had a tremendous run these last couple weeks. It's unbelievable. We respected this white trend line all the way up for months and months and months. We consolidated on it, and once we broke it, panic ensued. We almost fell all the way down to the 200-day moving average, but since then, it's been a V-shaped recovery like we haven't even seen. More bullish than any of this momentum back here. It's almost been straight up. And what it did was it faked a lot of people out. It got them to sell all their positions, and then they were waiting for it to keep going lower, so they didn't buy back in, or they kept shorting the market. And that just gave more and more momentum for the market to keep going higher. Now that the S&P 500 has broke back above this white ascending trend line, I would expect it to make it a nice support, maybe consolidate for the next few days. We need to be watching this line like a hawk. If we do hold it and continue to the upside, we remain bullish. If we start to break back through it, the next stop's going to be the 45-day moving average, and if we can't hold that, we might come all the way back down to the lows. But as of right now, this is a very nice V-shaped recovery, extremely bullish. I would expect maybe some sideways chop action just until we get to Nvidia's earnings, which is going to be on the 28th. So that's definitely going to be something that's going to be a market mover and something to watch out for. Onto the NASDAQ, we've also had this extremely fast V-shaped recovery. We actually did come down to the 200-day moving average after breaking through this white ascending trend line. That's a very, very nice long-term support, a great buying opportunity if you were able to take advantage of it. And look at the price action since then. We've been straight up. Now that we've recovered this white trend line, it's the same thing as S&P 500. I'm expecting it to do a little bit of chopping and turning, maybe even come back down since we're a little bit above it, show that we're going to make it support, and then continue to the upside, guys. There still is a lot of fear out in the market. People are still calling for recession. People are still thinking that the Fed's not going to cut rates. There's a lot of things that are keeping people out of these markets. The more fear that we have in the market, that means people are either keeping their money out or they're choosing to short the market. And what that does on a run like this, they keep getting squeezed out of their positions. As they're losing money, they're forced to buy, and that joins the buying pressure, which is also pushing the stock market up. So we've got sellers getting out of their positions, pushing the market up. We've got buyers buying into the market. We've got new buyers buying into the market. And we still have about $6 trillion in the money market funds that are getting that 5% interest rate right now. Once the Fed starts to cut and they're no longer getting a good enough interest rate, a lot of people are going to take their money out of the money markets and try to get a better return in the stock market, which is also going to push the stock market even higher. So we're looking extremely bullish on all fronts. Remember, Tom Lee's calling for 40% by the end of the year on the Russell 2000. That would be magnificent. But just remember, this isn't the first time he's called for it. He was wrong last time he called for it, but he's not wrong often. So take everything he says with a grain of salt and only invest in stocks that you feel comfortable holding. I hope you guys enjoyed the video. If you did, smash the like button and subscribe if you haven't already, and I'll catch you in the next one. Peace.